Hi guys. Today we will analyze Google stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The short-term trend is positive, while the long-term trend is neutral. Support levels are around $2,820 and $2,660. Strong support level is around $2,500. Resistance level is around $3,015. Volume is considerably higher in the last couple of days, which is what you like to see during a strong movement up. Price movement has been too volatile to find a nice entry point. It is probably a good idea to wait for a consolidation first. The stock has an average volume of 1.5 million. This is a good sign, as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 24% per year, for last 5 years. We see that the average profit margin of the stock has been around 21% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 110% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Google company: bad, average, and good. First scenario. Google will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 8%. Future profit margin would be low, 20%. Future free cash flow to net income rate would be low, 80%. In this case, the fair value of the stock today would be $1,388. The second scenario. Google will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 11%. Future profit margin would be average, 22%. Future free cash flow to net income rate would be average, 95%. In this case, the fair value of the stock today would be $1,991. The third scenario. Google will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 14%. Future profit margin would be high, 24%. Future free cash flow to net income rate would be high, 110%. In this case, the fair value of the stock today would be $2,777. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 112.2. Minimum rate of return. I will use 12%. Because when we invest in individual companies, we are looking for a higher return than the S&P 500. For Google, analysts forecast growth rate around 16% per year in next 5 years, and future P/E around 25. Again, I will use 3 different scenarios for Google company: bad, average, and good. First scenario. Google will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 8%. Future P/E would be low, 21. In this case, the fair value of the stock today would be $1,698. Second scenario. Google will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 11%. Future P/E would be average, 23. In this case, the fair value of the stock today would be $2,380. Third scenario. Google will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 14%. Future PE would be high, 25. In this case, the fair value of the stock today would be $3,289. As you can see, today the stock is fairly valued, $2,865, if we expect the company's high performance in future. The fundamentals are great and the stock is currently fairly priced if you expect Google's high performance in future. Google announced that it plans to do a 20-for-1 stock split in July 2022. The split may push the stock's price up. I bought the stock a few years ago, and I will buy more if it drops below $2,600 before the split. Company's strengths. Google is the world's leading internet search provider and the world's largest generator of advertising revenue through YouTube. The balance sheet remains sound. Google Cloud continues to ride the ongoing migration of enterprise apps to the cloud. YouTube Ads is benefiting from the ongoing shift of global ad spend to digital online. As the number of online users and usage increase, so will digital ad spending, of which Google will remain one of the main beneficiaries. Android's dominant global market share of smartphones leaves Google well positioned to continue generating top-line growth as search traffic shifts from desktop to mobile. Massive long-term potential, including machine learning, natural language processing, and efforts in cognitive computing, self-driving vehicles, quantum computing, drone delivery, smart homes, and wearables. Risks. There are some concerns about the regulatory environment and pressures from higher operating expenses, capital spending. Some governments may simply forbid access to some of Google's properties, which could result in lower user growth and monetization. Google's dominant position in online search is not sustainable, as more companies and regulatory agencies are contesting the methods through which the company has been extending its leadership. There is little revenue diversification within Alphabet, as it remains heavily dependent on Google and the state of the search ad space. Google is allocating too much capital toward high-risk bets, which face a very low probability of generating returns. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.